At the end of the lecture, you should be able to differentiate long-term financial plans from short-term financial plans. Prepare cash budget for cash planning. Prepare pro forma income, profit and loss statement for profit planning. Lecture outline. Introduction to financial planning. Long-term financial plans. Short-term financial plans. Cash budgets. Cash receipts. Cash disbursements. Profit planning. Pro forma profit and loss statement. Financial planning is important because it provides the roadmaps for guiding, coordinating, and controlling the firm's action to achieve its goal. In a nutshell, it provides one unified direction for the firm. Long-term financial plans are planned long-term financial actions and anticipated financial impact of those actions, also known as strategic financial plans. It covers usually a period of 2 to 10 years. It's reviewed regularly, usually over a period of 5 years. It's a part of an integrated financial plan, along with production, marketing, and other plans. Long-term activities include buy fixed assets, marketing and product development, research and development activities, major source of financing. It is supported by a series of short-term financial plans. Short-term financial plans are planned short-term financial actions and anticipated financial impact of those actions, also known as operational financial plans. Usually covers a period from 1 to 2 years. The key inputs are sales forecasts, operating data, financial data. Key outputs are cash budgets, pro forma income statements, pro forma balance sheet. You can see the link between the long-term and short-term financial plans are supported by a series of short-term financial plans. Our focus in this lecture will be on the short-term financial plans, which consists of two key aspects. First, cash planning, which involves the preparation of the firm's cash budget. Second, profit planning, which is usually done by means of pro forma financial statements, pro forma income statements. Let us look at a simplified diagram that explains short-term financial planning. There are three key financial inputs. They are sales forecasts, actual income statement for the current period, actual balance sheet for the current period. With sales forecasts and income statement, you can produce a key output here, that is pro forma income statement. With pro forma income statement and sales forecast, you can create another output, that is cash budget. Finally, with cash budget, pro forma income statement, and actual balance sheet, you can create the pro forma balance sheet. Cash budget is a statement of planned cash receipts and cash disbursement used to estimate cash surplus and cash deficit. Let us look at this formula to find cash surplus or cash deficit. Total cash receipts inflow minus total cash disbursement outflow gives you net cash flow. Net cash flow plus beginning cash balance equal ending cash balance. Ending cash balance minus minimum cash balance gives you, if it gives a negative figure, that will be a cash deficit. This is required total financing. Here it requires to look for short-term financing. Or if you give a positive figure, that is cash surplus. There will be excess cash balance. This you can invest in short-term investment. Cash receipts include all items from which cash inflows result in any given financial period. The most common components include cash sales, collections of accounts receivable, dividends received, proceeds from sales of assets, cash disbursements include all outlays of cash in the period covered. The most common cash disbursements include cash purchases, pay account payable, pay dividends, pay rent, pay salaries, pay tax, buy fixed assets, pay interest, pay loan principal, repurchase stock. Non-cash items exclude depreciation expense. The profit planning process centers on the preparation of pro forma income statement. A pro forma financial statement is a financial statement projected over some future time period. These pro forma statements can be analyzed using ratio analysis to anticipate and assess potential problems and areas of weakness, and thus help management to formulate contingency plans.